In this video, I'm going to show you exactly how I'd start my day trading career over if I had to start as a beginner. Because before getting to the point of setting my trading up to be able to have between $7,000 to $10,000 single profit days, I honestly wasted years of my 20s along with tens of thousands of dollars had I have known the foundations and information that I'm going to be sharing with you in today's video. So I'm going to first start with trading foundations. So a simple way to actually understand trading, which is going to make everything else easier. Then I'm going to cover websites and tools needed to follow this process. I'm going to explain how I rewired my brain with trading psychology and how it was literally the most important element of trading that will either make or break someone's success. Then I'm going to explain simple trading math and the math behind professional trading. I'll then cover a complete crash course of the most important technical analysis elements that I use to trade the markets. I'm going to then show you how to actually build and test your own strategy. Then at the end, we're going to take everything that I've showed you, apply them into real life scenarios to show you them working in real time. So by the time you make it to the end of this video, you'll have a clear, simple path to starting your day trading career. So I first want to get into explaining trading in its simplest form because there's so much information out there and it can be so confusing. This is my guiding light and my sort of North Star when it comes to where I frame my mind to be able to then learn everything else and be able to execute everything else. So when you're starting off, this is important to remember. Markets are simply neutral data. It's a representation of mass human psychology, and us as humans are connecting emotion to the data. The data doesn't care about you. It doesn't care about your feelings. Okay, it's completely neutral data. So our job as traders is to take this random market data, be able to create rules, trade criteria, a trading strategy to then be able to filter out all of the noise, all of that random data to then build a machine to create profit over time. That's literally all we're doing as traders. Okay, and one thing that I want you to really lock into your mind before we get into all this information, trading has nothing to do with being right or being able to predict the markets. Over the past 3 months of trading, my win rate has been around 36%, which means I'm losing 67% of my trades. So once again, trading is really just about looking at neutral data and using this data, using trading strategies to pick key areas in the market where we expect price to flip, be able to buy in hopes that the market then moves in our direction, in which case, if it does move in our direction, we make 5x what we were risking on the trade. And all we're doing is reading these supply and demand imbalances. We don't need to be right every single time. We don't need to be able to predict the future. This is just simply filtering data and building up a complete process. But especially as we're talking about day trading, there's a lot of math, analysis, strategy, actually being able to input and execute these trades that you need to be able to learn to actually put yourself in these positions. And that's what we're going to get into. And by doing analysis and understanding the way these markets flow, be able to pick really precise areas to enter in. You see I'm up $1,600 in profit already and be able to keep my risk contained, allow the markets to move in my direction much further than what I'm actually risking. You can see I locked in $1,300 here. I have $3,200 in profit. This is risking $1,000. This is not to brag, not to show off. It's simply to show you if you start to understand all of this information, you really don't need to be right all that often. You just need to be able to trust your process, trust your execution, and trust your analysis of the market. And this is the opportunity at hand that is possible. And the cool thing is with what I'm going to share with you, you really don't need to start with that much capital to be able to scale it. Okay, so now I want to share with you some tools and softwares that are needed for the day trading process. Okay, and this is what I use on a daily basis. So first thing that you're going to need is TradingView. It's where we're going to be doing all of our charting, all of our analysis. It's sort of our home base of trading and investing. The second thing that you're going to need is a way to actually execute these trades. So I trade crypto often, so I'll use Blowfin or Bybit. For those of you that want to trade stocks or futures, most of our traders are trading on TopStep where they can pass evals, get funded accounts with this. Okay, and lastly, you'll need a trade journal to actually input your data. Okay, I'm going to be providing this one to you if you want to use it in just a second, but more on that later. All right, so let's go back over to our foundation, which is TradingView. Once you create an account on TradingView, you're going to go up here into products and then click on super charts. Okay, and that's going to take you to a standard chart. I have a video explaining exactly how I set my TradingView up from scratch and how I set all my charts up. If you want to dive a little bit deeper into that afterwards, I'll put that at the end of this video. But basically, this is going to be our trading foundation of where we're finding our trading ideas, sort of our home base, and do all of our analysis. So when we're trading, we're effectively trading what are called pairs. Pairs are basically whatever investment vehicle we're trading against either another pair or the dollar. So in this case, if I'm trading something like Solana moves around in price and the dollar is fairly stable. So we're trading the value of Solana against the dollar. So if Solana turns stronger than the stable dollar, price will go up. If it starts to get weaker, comparatively, it will get weaker. And that's effectively why we're seeing swings down and swings up in price. It's our job as traders to be able to read and position ourselves into these moves. So when I'm trading, what I'm doing is going over into this tab on TradingView here and building a watch list of things that I like to trade. So typically I'm trading Solana and Ethereum. Okay, if I'm trading futures, I have all of my pairs here. So I have MES, MNQ, okay, and then I have oil and gold right here. And this is basically going to allow me to be able to easily click through and keep track of all the pairs pairs that I'm looking to potentially trade. So when it comes to reading this data, we can look at it in a few different ways. So if I click over to a line format here, all we're looking at is basically the price movement with no other information. What most traders are using are something called candlesticks, which is basically showing us green candles, or in my case, white candles. We had this is the open price, this is the close price, this wick is the highest the price went over that time, this is the lowest the price went over time, and then the same is true for a red, or in my case, a black candle, which is signifying that the price opened higher than it closed, so it was a net decrease over time, with this wick representing the highest and the lowest that the price has gone over that point. So there's a lot of information that we can actually read about the chart based on how these candles form, which we'll get into a little bit later, but this is primarily how I'm reading charts. Okay, and additionally, we can look at these candles in different what are called time frequencies. You'll see on the left hand here, each candle is representing 1 minute of price movement, and this same increment of data is effectively being shown with 9 candles here because we're on a 30-minute time frame. So each candle, instead of 1 minute, is showing me 30 minutes worth of price movement. We can use these in different harmonies to be able to make sure that our ideas are aligning. This is something called multi-time frame analysis. I'll also be linking a video at the end of this video that dives a little bit more into these advanced topics. Okay, but for now, understanding for day trading, we're typically using between a 1 and 5 minute time frame, which allows us to get in and out of the market pretty quickly. So this data is basically what we're going to be using to set ourselves up in positions where we can keep our risk contained and start to predict areas of the market where we expect price to flip to allow us to be able to make profit. All right, so when it comes to actually analyzing the market and finding these key opportunities, there's a million different ways to do this. I'm going to boil it down to the 5 simple ways that I'm doing my analysis to find these trade opportunities. Okay, I have a video where I get into way more depth that I'll put at the end so you can dive a little bit deeper. But the first thing that I'm always looking for is basically being able to identify trends. Okay, so we can see these sort of invisible levels that price tends to bounce off of that we can use this trend line tool to click along the bottoms of to sort of see where we're getting all of these contact points. And this is going to show me the general direction of the market. And this is important because this is going to allow me to basically see if price pushes up this way, comes back down, has a response, and then comes back down to that level. Okay, this can give us sort of key areas in the market where we can expect to get a change back in the opposite direction, which can allow us to position ourselves accordingly. You can see we can do this all over our chart to get general areas where we can expect price to move down and bounce back off of. Okay, once again, price pushes down, comes back up, touches that same exact point that was touched over here, and moves down. So this is already giving us a general idea of where we can be looking. More importantly, this is something that I look for a ton of the time. If we see a trend developing where we're getting multiple contact points, once we get price to actually break one of these levels, we can actually anticipate where this next potential downtrend is going to have its last point of contact before reversing down. So you can see after drawing this critical level, price comes back up, now touches the underside portion of this trend, which you can see is a last point before making a major move to the downside. Okay, this once again can open up opportunities for us to position ourselves so when we do see these breaks to enter in to once again play big moves to the opposite direction. So the next important tool that I like to use is something called a Fibonacci retracement, which is right here on TradingView. So if I set up this indicator, you'll see we have these key values here. Okay, and I use this in a few ways, but typically if we have a trend that's moving in this direction that tops out here, these are our key retracement levels that we can look, that we can see if price is responding well on the way up, we can expect price to also come down to these critical levels, and if there's a response there, we can expect price to move off of those levels. So we have 23.6, 38.2, 50, 61.8, and 78.6. Okay, oftentimes with uptrends, if we're going to get a continuation in an uptrend, a response off of this 50 level is considered a continuation level. If we're getting a reaction down to the 61.8 level, this one is considered the golden ratio, and if we're getting a response off of here, this is a full retracement that price tends to go down to before making a full continuation to the upside. Okay, so sort of as the trend is developing, I'm sort of looking at whether or not we have proper responses off of these levels already, and then once we do get the sell-off, we can look to get in on dip buys at these critical levels. We can literally find this all over our chart. So if we look at this downtrend here, where we have a contact point, contact point, contact point, and then price breaks above that level, we can now take this Fibonacci from here to here, and you can see price comes down, touches off of that exact golden ratio before having a full move to the upside. Once again, if we look at our previous example where price drops underneath this trend level and comes back up, I can click on my fib retracement, start from this high point down to this point, and you can see price comes exactly up once again to that 61.8 level golden ratio, responds off of the underside of this trend before making its move all the way to the downside. So once again, you can go much deeper into this stuff, but now you're starting to understand how we can look at this randomized data and start to quantify them and find these key areas where there's a higher probability of getting a response off of that area. Okay, and as far as reading getting the candlestick data, like I was saying earlier, the next probably most powerful tool that I like to use is something called a fair value gap. Okay, so what a fair value gap is a series of 3 candles where the first candle's highest or lowest wick doesn't overlap the third candle's highest or lowest wick. So in this scenario where we have 3 bullish candles, meaning the price is moving up, this first wick level and this third wick level leave a gap between, and this is called a bullish fair value gap. And you'll see we have this midpoint here, which is a level called consequential encroachment. Now, oftentimes this level is responded really nicely off of, and price will pull back into these areas, have a response, and then make a continuation once again to the upside. So this can give us really high impact zones, sort of in conjunction with our other analysis, to once again further filter down all of our data and pick really, really good entries. Okay, and the same thing is true with a bearish fair value gap. So if we have price action moving down, 1, 2 bearish candles, we can draw from this wick to this wick, and you can see price trades back up into the midpoint after breaking out of this trend level before making a significant move once again to the downside. Okay, so on my chart, I like to use an indicator that populates them automatically. So you can see this sort of gives me these highlighted areas to see price sort of dip into that can give me these high impact areas once again to target. Okay, so you can go back to our other example here where we have fair value gap respected, fair value gap didn't quite get touched, fair value gap respected off of here, price breaks underneath that trend level, price continues pushing down, starts to now make its way higher. I can take my Fibonacci retracement right here. We see our high impact fair value gap at this level, price comes up, comes right into the underside of this trend, 61.8 on our fib, as well as the midpoint of this fair value gap all simultaneously, which once again gives us a higher impact area for us to read for price to decrease and be the last sort of potential point before a massive move in the opposite direction. Okay, so the next tool that I like to use is something called a trend-based fib extension. Okay, so this is once again using that golden Fibonacci ratio, but now we're using it to try to predict the tops of trends. The way that we're going to do this is basically by once again identifying that we have a trend, right? So we have price breaking out of this area, once again reacting off of a fair value gap and continuing to move in an up direction. But now what we want to do is measure this sort of first move up like this. Okay, then I'm going to click on my trend-based fib extension, go from this low up to this high point here, back down to that low. And what this is doing is taking that golden 61.8 ratio, multiplying it by the distance of this first push, which is giving us 161.8 value, 261.8 values, 361.8 values. Now this is going to be paired with me looking for what's called a 5-wave pattern. Now trends typically develop in 1, 2, 3, 4, 5 waves. Now if we see this trend sort of developing up and creating a 5th wave and responding off of one of these multiples at one of our key points, I like to use this to give me an even stronger indication that we are potentially at the top of a general trend. So if we have all of this, we have our trend level, you can see then price breaks down through it, producing one of these fair value gaps. And you can see price comes directly into the midpoint of this fair value gap before making its way down lower, which I can also use to basically be able to read these overall trend flows and get a better idea of when trends will tend to top out. Okay, the next most important thing to understand, and this is probably the thing that will either make or break your trading, is understanding how to rewire your mindset and understand trading psychology. I promise you this is the pivotal point where I know a lot of people who are very smart, who know a lot about trading, that haven't mastered this one element, and it basically makes all the other information useless. Then I know people who maybe aren't even that good at trading, but understand this one core principle and are in a far better position to succeed. Okay, so really make sure that you lock in and understand this before we get any further into strategy. Okay, so the first thing to understand, and this is what I was saying earlier, trading has nothing to do with being right or wrong. So being wrong about a trade does not make the trade bad. And that's something that's really, really critical to understand. So to fully understand these, let's look at this example over here. So anytime we're entering the market, one of two things is going to happen. If we enter here, either price is going to reach our target and we're going to make a profit, or it's going to come down and reach our stop loss, in which case we are going to lose a contained amount on the trade. So every time we're entering the market, as a trader, we're fully accepting the possibility that even though we have all of our rules in place, that we have confidence and belief that our trade can move in our direction, it is very well possible with a completely random market that price can also move against us. And this makes it absolutely critical to set your position up so that your risk is contained. And in trading, we use something called risk factors. Whatever we're risking on a trade is considered a -1 risk factor. Whatever we're expecting to make if the trade is to move in our direction is a positive risk factor. Okay, so it's really important to understand anytime you're entering the market to figure out exactly where you're going to exit the market if the market is moving against you, and to be able to enter with the proper amount of units so that the risk that you're putting on the table, whether your stop loss is this big or this big, is always remaining at a fixed 1 risk factor. And there's an easy way to do this that I'm going to share with you in a second, but I think it's important important to understand how the math works behind this. If you're trying to find your one risk factor, what you do is you take your entry price, so let's assume it's 135 in this case, 0.5, subtract it by the stop loss value, which is 130, that gives us 5.5. And say on this trade we want to risk $100, we'll take $100 and divide by 5.5. Okay, and that's going to give us 18.18 units for us to enter with at this specific level, so that if price travels down by 5.5 units times however many we entered at that price is going to give us exactly the dollar amount that we want to risk on that specific trade. Obviously, these numbers are fairly easy, but it gets more complicated as the numbers get more random, so it's important to understand that math. Okay, and if you want an even easier way to do this, you can go into indicators, click on the InnevaTrade position size calculator. You can click on your entry, click on your take profit, click on your stop loss. You can put in the dollar amount that you want to risk, hit apply, and that's going to give you the exact quantity that you need to enter at the exact price to risk a specific dollar amount, and it will also give you the expected profit level if your trade goes to full profit. If you want access to this, you can go in the description, follow me on Instagram, and DM me the word tools, and I'll send it over to you. Okay, additionally, if you just want to double click into your position calculator here, you can put your account size. If you want to use percent or dollar amount, say we want to risk, once again, $100, I can hit OK. And you can see that's also going to give you the 212 quantity to be able to risk that $100. So understanding this, you know, anytime you're entering a trade, you can be wrong, and that's absolutely okay, because that's opportunity cost to put you into the market. Okay, that also means that losing a trade and being wrong doesn't mean that there needs to be a corrective action. Typically in life, we think, you know, when you do something wrong, you need to learn a bunch of things or try to repair it so that that never happens again. Okay, but say we take this example where we have 10 total trades, and in this situation we lose 1, 2, 3, 4, 5, 6, 7 trades out of 10, but of the 3 trades that we do win, we allow our profits to run, where we're able to make positive 5.3 R, 2.4 R, 3.1 R. That's going to mean that even though we're losing 70% of the trades, we know our average loss is negative 1 R. We have a total of negative 7 R. We have a winning percentage of 30%. Our average win size is 3.6 R, and we have a sum of positive 10.8 R, which is putting us up 3.8 R times whatever we're risking on the trade. So if we're risking $100 per trade, that means that we're up $380 in profit, being wrong 70% of the time. Okay, and this table is going to show you the 2 metrics that are really the key and all you effectively need to know. You need to know your average risk reward ratio and the percentage of the time that you win trades. So if we look at this data example, if we're keeping our risk uniform, we know that our average risk is negative 1 R, and we know our average off of these totals is 3.6 R. So in this scenario, if we have between 3 and 4 R and we're winning whatever percent of the time, we're going to be somewhere in this area, which you can see is on the line of profitability. Okay, so even though when we're entering a trade, either this happens or this happens, we know that it's not true that being wrong about a trade is bad, because it's opportunity cost. We know that losing trades are pre-calculated and built into our calculations for our trading strategy. Okay, and we also know that we need to keep our risk uniform. So making money on a trade does not make it a good trade. What a lot of people will do is they'll revenge trade, right? Where their one risk factor is normally $100. But say you have your risk baked into your system and you decide to put half your account on one trade. Yes, if the trade goes in your direction, you make a ton of money, but you basically put all of what you've been building at risk for one trade based off of your emotions, based off of your feelings. And yes, maybe you made a lot on a trade, and if you told anyone, oh, I made a ton of money on the trade, they'd say, oh, that's awesome, good trade. But you risked basically half your account, which does not make it a good trade and will inevitably lead you to failing over time. So you making money on a trade does not make it a good trade, and losing money on a trade does not make it a bad trade. The only focus should be understanding this math and adhering as closely to the process as possible that I'm going to show you how to do in a second. It's going to give you all of your data and allow you to actually make money over time. Okay, so now let's get into building a trading business plan and getting it from an idea to actually being able to deploy it into the markets. So everything is going to start from an observational idea. So any pattern that we're seeing over time, that's going to be step 1, finding that observation. Off of that observation, what I do is then create a rule book. Okay, that rule book is going to be something called entry criteria. So if this, then this. If I see this, then I will do this. Once you have that group of rules, the next step is to test it in a simulated environment and evaluate the outcome based off of the 2 metrics that we just learned about. So the winning percentage and the average win and average loss. And once we analyze that information, we're going to determine whether or not that's profitable, or if we need to go back to the drawing board until we get to a point where we're in a profitable area, in which case we can go to the next step of the process. This is where we're going to start to use our trade journal. Okay, so once again, go in the description, follow me on Instagram, DM me the word tools. You can download it and then you can follow along. Okay, so what I do when I'm doing what's called a back testing session, this is where we're going to start understanding our data, is we're going to pull up our trading view on one side where we have our watch list and whatever pair we're looking to trade, and we have our journal on the other side. Okay, what we can do is click on this button right here, which is going to put us into something called bar replay mode, and we can basically go back in time and click to a random point and basically start trading from there. So I'm going to use a really simple strategy example. So don't take this literally, this is just for an example, but I'm going to show you how we're going to book our data and then look at our data to be able to then go to the next step of testing. Okay, so what I'm going to look for in this strategy is using something called a cloud highlight RSI, which basically shows us where the market is potentially overbought and oversold. And I'm going to buy every time we get a signal that it's oversold and sell when it's overbought. Okay, so in this situation here, we have our highlight right here. Okay, so I'm going to notionally buy here with a stop loss. And all I'm going to do is sell when we get a highlight. All right, so we have our highlight here. Then all I'm going to do is look at how many risk factors right here I would have made on that trade. So say I'm risking $100 in this position, that would be $948 in profit. So I'm going to click into here. I can add the date. So that would be September 18th, which is a Thursday on Solana. Okay, you can pick your strategy type. This is on a 5-minute time frame. This was a long. Say my risk was 1%. I had a win. I made 9.48 risk factors and $948 on the trade. So say I'm going to sell in here, put my stop loss over that point. So we're out here when we get our highlight. So we made 1.3, so it was a short, another win, 1.3R, $130. Okay, we have our average risk factors being produced right here and our total profit. So say we enter our next position here. So that's -1. So that's our first loss. I can duplicate my section, long, check the loss, -1, -100. So we'll buy in again here. It's another loss. Okay, say we're buying in here. We have another loss. We buy in again here. We have another loss. Lots of losses. Obviously, this is an example, but you can do this over 30, 50, 100 trades. And what we can do is click on this filter button and then click on filter wins and click on checked. And what that's going to do is give you your average win size. And if you click to unchecked, that's going to give you your average loss size, which should be around -1. So now you've observed something, you've set defined rules, you've quantified how those rules, following those as stringently as possible, will result in the sense of these metrics in terms of your winning percentage and your average win and loss. Okay, and then all you're doing is looking to see if you say are right 40% of the time, your average win size is say 3 times what you're risking. That's going to put you into a profitable area, in which case you can move to the next step. So your observation is going to be your on-chart test, where you're basically looking to see if it's even a good idea to start with. Okay, bar replay is what we just did in our testing environment to see if we're even on this profitability table. The next thing that you're going to do is something called paper trading on an exchange. And it's basically using demo funds to be able to actually trade this in real time with actually executing these trades in a simulated environment on the exchange. So when it comes to paper trading, you can go over to one of these trades. You can see you can click into demo trading and you can actually practice executing these orders. Okay, so say we wanted to enter this position from our back testing session. Okay, so I'd click into my never trade position size calculator, click from here, here, here. If I want to risk $100, I would hit apply. That would give me my quantity. Okay, so this is where I would go over, select my pair, click into limit order. I would put my entry price here. I would put my quantity at 119. I would check this take profit stop loss box. Take profit would be 250. Stop loss would be 242.03. And you can see this is putting us at exactly $99 worth of risk because we've positioned ourselves to have uniform risk. Okay, but even though we're risking only $100, you'll see this is going to require a position capital of almost $29,000. Now, this is what's cool about cryptocurrency or using prop firms is basically, you can see we can click into here, basically use something called leverage. Now, if we go up to 20x leverage and hit confirm, now you can see that same $29,000 position divided by 20 is now only going to require about $1,400 of our own capital. You can see if we use 10x leverage, now it's basically dividing that total needed by 10. Now the goal is to use the least amount of leverage because you are paying the fees on the total position size, but this is going to allow me to effectively start with, say, $1,000 to risk $25 per trade. And this is how you can start pretty small as long as your process is good to be able to compound those gains over time and actually be able to scale accounts starting with a smaller amount of capital. And you can also use demo accounts on Top Step as well and follow the same process of doing exactly what we were doing before, but now executing it as you would within the market. Okay, now that should be ran through several months worth of data where you're collecting it, making sure that you are consistent over time before then actually putting money to work in the market with an actual account. But now you have all of the data to back it up. You have all of your infrastructure to trust your process, not trade with emotions, and be be able to do it the proper way. Okay, so now let's take everything that we've learned, and I'm going to show you an entry model that I've been trading recently, and I'm going to show how all of this stuff comes together and how I execute in real time in real life scenarios. Okay, so the first thing I'm going to do is toggle on this indicator that we built on the private side of our trading team, which is basically going to populate trade signals for me based off of criteria that we have custom coded. Okay, you'll also see that I have my fair value gap indicator on that's going to give me some ideas. So I'm going to be waiting for that signal. You can see we have an established downtrend right here. We do have this fair value gap that's already being tested into, but what I do is wait for a break of this trend level. You can see we have a high impact push through this trend and one of those fair value gaps left behind. Okay, if I use my trend based fib extension off of this point, in this point, you'll see that our 361.8 was perfectly hit after a 1, 2, 3, 4, 5 wave pattern. If I drag my fib from here to here, you'll see that our 61.8 level was perfectly hit off at this point. So now I know if price comes back down, we have this level of support here at the 50 continuation zone. I have the 61.8 zone, and I have this bounce point off of my trend level. Okay, so I can set up a position here with the stop loss below that area. Price dips back into my entry, tests the opposite side of that trend. I can use my position size calculator for entry, take profit, say risking $100. I can enter in with my units. Then let the price move in the direction of my trends. And you can see that's the last area that the price went before a completely new direction in the trend. So even being right about one of these ideas can yield 7, 8, 10 risk factors sometimes. This is a strategy that I'm trading currently that over the past 3 months, I've been able to make just under $100,000 trading. You can see students using this, Joe, having an insane week, 3,400, 6,600, 4,200. You can see Greeth using the full scope of this, 32 risk factors. Once again, it's not about predicting the markets always being right. It's about understanding the math, understanding your system, and being able to deploy it consistently. Make sure you subscribe and like the video if you're still here. And if you want any of the tools, go in the description, follow me on Instagram, and DM me the word tools. Like I said, if you want to dive into setting TradingView up in more technical analysis, I'll put the 2 videos here. You can check out our private team right here. But until next time, I will see you all in the next video.